Have China's markets suffered enough? Is it finally time to reach the end of the road on all of this negativity? Welcome to Macro Money. This is Elias Spivak, head of global macro at tastylive. We're going to be focused on the world's second largest economy today, just ahead of them releasing GDP data in just a matter of hours here. As ever, if you are watching this on YouTube, do jump in the comments, share your thoughts. What do you think about China's economy? What do you think the story looks like as it contributes to global growth going forward? And we'll incorporate your thinking into the show. Of course, feel free to opine on things that aren't China related as well. Now, this, of course, has been a huge disappointment for the markets this year. At the start of 2023, there was so much optimism built into the idea that China was going to finally reopen from COVID restrictions that would bring the world's second largest economy back from isolation, back from economic separation from the rest of the global supply chain, and be a tremendous tailwind for global economic activity. Boy, have those optimistic ideas suffered since this process started. And now the question really comes to be, have they suffered enough? Markets are, of course, forward-looking. As they get incoming information, they discount that information with asset values going up or down, depending on if the information calls for this or that. If the flow of information stops pushing the ball, either forward or backward, well, then there's a level of exhaustion in the response from price action. And you stop having market moving potential, even without the reality on the ground necessarily changing. And so this really is the main question for us here. Given how badly Chinese assets have done so far this year, and given the tenor of news flow coming out, as we look at these third quarter GDP numbers that are immediately in front of us, have we reached some sort of point of exhaustion on negative news flow? Have the markets already seen the critical mass of bad news coming out of China? And does that mean that we might have something of a recovery in the wings? We start the conversation with just an assessment of what's going on here. GDP data or no GDP data, it's important to understand the lay of the land and what's really been happening in China since the beginning of the year. So we'll look at that. And we start with the relative performance. So you can see here in the green is as a kind of benchmark, the S&P 500. So call that Wall Street. That's what U.S. stocks have done so far this year. They're up close to 14%. Much of that is tech. We can see that when we strip out tech out of the equation, U.S. markets are actually down 1.5%. So it's really tech that's overpowering on the performance front. But when you look at measures of Chinese markets, be it the X-Tracker's broad-based ETF, ASHR, that tracks the CSI 300, which is essentially China's equivalent of an S&P 500, a kind of catch-all of both the Shenzhen and the Shanghai bourses and the top names there. And then the large cap index ETF, FXI, we can see that the declines there are staggeringly larger than what we're seeing for the U.S. market in general. And even if we were to push it into negative performance by taking tech out of the equation. So the overall market in China year to date down over 9%. The large caps down almost 6%. So clearly a very ugly picture here for China. after they attempted to reboot the economy with the scrapping of COVID restrictions back in December of last year. Now, it's not surprising why this is occurring. We can see here that China's main export markets saw growth peaking long before they decided to rejoin the party. So we started to get reopening and the relaxing of COVID restrictions in the U.S. and the Eurozone conveniently at the same time that fiscal stimulus in both areas really hit critical mass. And so we were able to see these very fast catch-ups in economic growth. You can see this is composite PMI data. As ever, 50 is the center line, at which there is neither growth nor contraction. Under 50 is contraction. Above 50 is growth. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. And so you can see here, U.S. has composite PMI numbers which capture both manufacturing and the service sector well north of 60 when we get into the peak in the middle of 2021. These are staggeringly large numbers, very fast growth. And of course, that reflects catch up from having the economy almost completely shuttered. And of course, also reflects a tremendous dose of fiscal stimulus dumped on top of the economy. We see a very similar story in the Eurozone. That peak is a little shallower because there's less stimulus, and it occurs a little bit later because that stimulus arrives a little bit later. And so we have growth in China's main export markets for which it depends, peaking 18 months before China decides it's time to reopen the economy in December. And so not surprisingly, when it reopens, it's already reopening into a significant slowdown. It should be noted that by the time it opens, there's also already been nearly a year of aggressive rate hikes in both the U.S. and the Eurozone, because both of them at this point have an inflationary issue because of that very rapid catch-up growth and all that stimulus. So by the time China comes around to reopening, demand from its main customers has already been diverted because they reopened sooner and had to diversify supply chains around a still closed China for nearly 2 years. And next, growth in those markets is already on the wane by the time China needs demand from them. So every which way you slice it, the situation looks dire. And so you can see the pop in China is really very, very modest. You get a little bit of a lift through to March, and then everything comes undone again. You see that in spades in the trade numbers. So China has fallen aggressively as a share of global trade. You can see global trade in China has in fact been falling faster than it's been falling across the rest of the world. The whole world has been moderating as that stimulus wanes and rate hikes bite. But you can see that for much of the past 2 years or so, a little bit more, the dark grayish line there, which is global trade, it's been falling, but the red line, which is the same measure for China, has mostly registered underneath it. So it's mostly fallen faster. And the share of China as a part of global trade flows has come down to the tune of about 3%, all of which tells us that we're looking at a very significant deterioration in China's role as the global supply chain's value-add hub. But it's not just the export sector, because since China is this very critical export value-add hub, and since so much of its population is employed doing that, what this has meant is a knockback on domestic demand. the absence of the kind of robust engagement with trading partners that was there before the pandemic has meant that there's less employment, there's less income, there's a more generalized domestic issue. As we can see here, imports and exports have been falling in tandem. In fact, the last set of data that we got on this actually have them falling at the same speed, down 6.2% year on year apiece. What then weak domestic demand has done is it has punctured the housing market, which accounts for something like a third of China's economy in terms of employing people, in terms of exposure in people's portfolios. It's by far the dominant asset class, the property market. And we can see vigor draining out of it. As a matter of fact, we can see that the 70-city average house price in China has been falling in year-on-year terms since April 2022. You can see for over a year now in negative territory. The yellow bars that you see there is the housing price index that basically measures in PMI-like terms essentially what share of that 70-city average is reporting higher prices versus lower prices. So out of the 70 major cities, what percentage says prices are rising versus falling? And what we see here at the moment is that something around 20% of cities are reporting that the price for housing there is rising. That's this down here. You can see that corresponds to just under a quarter. That's telling us that if 20 to 25% are reporting gains, then 75 to 80% are reporting declines. So there is not only a loss of a significant amount of external demand, there's also a tremendous loss of domestic demand. Now, for their part, authorities in Beijing have been kind of lackluster about dealing with this. They've certainly tried to offer stimulus. They've tried to loosen some rules for house purchases. They've tried to inject more liquidity. There's been a modicum of rate cuts. But as we can see, that hasn't really done the job because financial conditions in China continue to be restrictive. You can see here they're on the tight side of the spectrum. So there's not been the kind of aggressive easing effort that we might have expected out of the West going on here. In fact, it seems like in comments from China's President Xi Jinping calling for higher quality, quote unquote, growth versus growth at all costs, a kind of sense that big splash fiscal stimulus like we saw in the US isn't on the menu. And the steps that have been taken by monetary authorities have very clearly left the situation still in tight financial conditions. So it's not really had the stimulative impact that perhaps was hoped for. So all of this, needless to say, paints a very dire picture. Anemic external demand, anemic domestic demand, falling housing prices, falling exports, falling imports, a reduced share of the global trade pie, which is absolutely critical to China's economic engine functioning well. So it's not surprising that foreign investors have been fleeing in droves. We can see that the number of foreign currency deposit holdings has been aggressively reduced. So we see a very rapid collapse in foreign currency holdings within China as capital flees. Not surprisingly, that has also compounded this liquidity situation. So not only is capital insufficient in terms of how much is being injected from the central bank and the authorities in general, but it's also being made tighter by the exit of foreign capital, which we can see here. So clearly the situation is dire, to say the least. And against this backdrop, we are going to see a GDP number, third quarter GDP number, that is expected to show us that year-on-year growth slowed from 6.3 to 4.5%. And of course, the operative question now is, well, we know all these bad things already. We know that the situation in China looks awful. We know it's probably going to continue to look awful for quite a long time if the government is seemingly becoming resolved to a longer-term period of anemic growth, and the demographic part of this story suggests that China's abundant labor force, the reason, incidentally, that it is the world's workshop, as it were, the cheap value-add node in the global supply chain until recently, that's going away because China's population is rapidly aging, and they were even forced to admit that it shrank for the first time in recent memory last year. So we're in a situation here where all this negativity has been with us for close to a year at this point. And here go these GDP numbers, and the question is, well, how much worse are they going to be than what we already know? How bad of a signal is going to come out from these GDP numbers that markets should think a global recession is even more likely than it already looks with everything that we already know is going on? Well, looking at the leading surveys of purchasing managers here, this is the official PMI data set from government sources. This is done in conjunction with the National Bureau of Statistics by CFLP, and which is essentially a trade group for purchasing managers and logistics professionals. And we can see here that indeed, if this was the second quarter right here, and this is the third, that indeed growth slowed in the third quarter. If we look at a private sector estimate of the same thing, this is from Caixin and S&P Global, essentially another version of PMIs from a different source. We can see here the same story. If this is the second quarter right here, you can see, so here's June, so that's mid-year. If you have the second quarter right here and this is the third, well then, indeed, we have seen a slowdown for the third quarter. So this is not going to be a large surprise for markets that things have gotten softer. We've long since expected this was going to happen. The PMIs have been telling us about it all along. It's been weeks now that we've seen these numbers start to percolate. Now, if we look at the economic data due to be released alongside the GDP, we're going to get industrial production numbers and retail sales numbers. We can see for industrial production, we're looking a little bit softer, down from 4.5 to 4.4. For retail sales, we're looking for gains. There we're looking to go up from 4.6 to 4.9. But both of these outcomes are expected to be basically in line with recent trends. So there's really nothing here that kind of screams catastrophe on any grander scale than we already see it. And this naturally raises an important question. Here is how Chinese economic data has been performing as a whole. This is an index from Citigroup that tracks Chinese economic performance relative to forecasts. And when the data is better than expected, the index goes up. When it's worse than expected, the index goes down. It's also scaled by volatility. So if markets move on a given surprise up or down, the index is adjusted more up or down. So what we can see here is from about the middle of July, Chinese economic data seems to have started to do a little bit, this is a word, less worse than expectations. So that the index is still under zero suggests that Chinese data still tends to surprise on the downside. But the margin by which it is doing so has meaningfully narrowed since mid-July. Now, is this because the situation has become better? Ostensibly, no. But it is because the markets have taken notice that things aren't going well and have slashed expectations. So the bar to surprising lower has become, as it were, higher. It is now more difficult for China to engineer very bad numbers relative to forecasts because the forecasts themselves have been lowered in the face of negative performance. We can see that here. This is a Bloomberg survey of Chinese GDP expectations for this year and next, and we can see, as one might surmise, and right on time, second half of July is where this starts, expectations for GDP growth in China have been meaningfully revised lower. And that is occurring at precisely the same time that these data outcomes are getting less bad relative to those same expectations. It is as if the bar to getting on par with or better than expected numbers has been pulled down. What this also means, however, is that more and more of this negativity has been priced into markets. And so again, the question is, what's going to show up in these GDP results, and for that matter, in the retail sales and industrial production numbers, that's going to be so much worse than expected as to make what is already a bad situation appear even worse and thereby inspire further weakness in markets that are anchored to China's performance. Well, it's difficult to imagine exactly how you get any worse than the dire situation we have now, at least in these numbers. The GDP slowdown very well telegraphed, as we just saw in the PMI data. The overall performance of economic outcomes relative to forecasts seemingly stabilizing. So data is losing its capacity to undershoot as expectations have been brought down. And even as this is occurring, we've seen a little bit of a green shoot emerge here and there. Over the weekend, we saw Chinese lending data. Nothing to rave about, but we did get a second consecutive month of positive growth in aggregate financing. So perhaps the credit taps are starting to open a little bit. Notice that we were basically at the start of this year when lending growth dropped into negative territory and has stayed there, but for the past 2 months. We seem to be starting to see some signs of life in lending. The pull on the yuan has seemingly crested. There's been a tremendous amount of yuan weakness and a lot of pressure as those capital outflows were gaining momentum. We can, of course, see that right here. What this implies is money coming out of yuan-denominated things and going to other currency-denominated things. And, of course, the medium of exchange that is the most ubiquitous is the U.S. dollar by a long, long, long mile. This is why these de-dollarization arguments make virtually no sense whatsoever at this stage. So what we see here in the orange line is where the market thinks the yuan should be on any given day. It's the market's estimate for the daily yuan fixing rate. And the official fixing rate has been set lower. This is on USD CNY, implying it's been set toward a stronger yuan to try to stem the tide. And what we see here is the disparity between these two has started to narrow, implying that maybe we've seen the worst. Maybe we've seen the peak of capital outflow pressure on this currency. And so with that in mind, maybe we've reached the sum of the known fears already priced into the market and have run out of bad news to spook investors. Now, what this means is that you might have a degree of bargain hunting emerge as long as these data points today are not improbably bad relative to forecasts. So unless we get wildly worse numbers on retail sales or industrial production, or for that matter, the GDP number, unless the internals of this report somehow prove to be wildly scarier than the truly very difficult situation that we already see, well, then the markets might be out of reasons to keep selling. And that could very well set the stage for bargain hunting and a rebound in China-relevant assets. And that might be FXI, that might be ASHR, the two ETFs we looked at earlier. It might be the exposed currencies and commodities like copper, like the Australian dollar. But we might be starting to get into a place where the markets have already discounted so much bad news that there's simply fewer reasons to be a seller. Everybody that needed to be a seller, and we're painting with a broad brush here, might have already sold. And what that sets up for is then a situation where the market becomes resilient to negative news flow and starts to climb the proverbial wall of worry. Because there are simply not enough reasons to keep selling, and therefore that in and of itself may become a reason to start to nibble in the other direction. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, head of Futures and Forex here at Tasty Live, and of course, increasingly with Dylan Radigan. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining, everybody. We'll be back tomorrow. See you then.